Take me back to when you started. How old were you when you started stock market investing?
Yeah, that was around 18, 19 years old. Back in, 08, 09. At the end of 08, I got in the market and just started buying some stocks. I had like a few $100 to my name. It was a crazy time too because the market was crashing. It was a great financial crisis. And ever since then, it was interesting. The best thing that did for me actually is it got me incentivized to save more money. That was the biggest thing because going into that, I don't know, but then I was like, oh, I have this incentive because I want to save, I want to invest and then make that money into money. And so it became fun to save money, I guess you can say, and then invest that money out. So yeah, long time ago. It seems like 100 years ago now, man. Holy smokes.
Your story, I think, is really inspiring to people because you started when you were in college. You were working at Walgreens for, was it $8.25 an hour?
Yep. Way back then. Yeah. And I went to community college, and that's actually where I started taking like accounting courses and business things. And that's where I really found like my passion for like business, investing, those sorts of things. I had a few good teachers back then. And yeah, I made hardly any money. But the one thing I always stayed consistent throughout the years was always having more income than expenses at the end of every single month, so I could always have money to buy stocks. And I did that since I was like basically a minimum wage worker all the way through today. And if there's one piece of advice I would give to every single person out there, it would be that. Always have more income than expenses, because then you're always in a position to add assets, whether that's real estate, stocks, whatever it is, and kind of build your portfolio out.
So how is it that you transitioned, or did you always start with individual stocks, and why individual stocks versus, say, a broad market?
Yeah, so I started with individual stocks right from the jump. And I mean, I think to understand me, you got to go all the way back to my childhood, which I grew up in a family of where gambling was very prevalent. Okay. And I wouldn't suggest anybody else raise their kids that way. But, you know, ever since I was a little kid, we'd go to the dog track and I would bet on the dogs, obviously illegally. But, you know, and I would find that, I could take less risk if I bet a dog to show. It means it comes in the top 3. And my dad, my brother's much older than me. He's like 8 years older than me. He was always doing sports gambling online and stuff like that. And my dad was as well. So I grew up into a family of taking a lot of risk, right? And like I said, that's not a healthy thing at all, but I saw that since I was a child. So I kind of started to understand risk reward on a little bit of a higher level than I think most people are. And I got adjusted to this like level of risk of understanding like, you can win this much or lose this much and things like that since I was a child. So for me to transition into the stock market wasn't that hard of a mental leap for me to make in terms of individual stocks. And I understood there's going to be a lot of variance that comes with this. And for me, that's just perfectly fine. But when it comes to individual stocks, I always viewed it as I own part of the business. And I learned that from Warren Buffett, because that's what he always preaches. Like when you buy stock in a company, you are buying actual underlying ownership of that company. So if somebody goes and buys, Apple stock right now, they're literally part owner. It might be like this, you own like this much of Apple, like you walk into the store and you own like this much of the square of the store, but you are literally part owner of that, right? And you can help vote on the board of directors, which those board of directors decide the executives of the company. And so that was just cool. I'm adding actual ownership of companies. And yeah, it's a small amount, but it is part ownership. And as those companies thrive over the next 3 years, 5 years, 7 years, 10 years, I'm going to thrive as well as a shareholder of that. And that's why I started down that route. And for me, it also made it a lot more fun because of the opportunity for outsized gains, which goes back to kind of that risk reward and things like that. I love doing the research on companies. Not everybody enjoys that. Me personally, I love that.
Do you actually tune into earnings calls? Do you look at everything every one of your companies says? You follow that religiously every day?
Pretty much, yeah. I will. So if anybody's watching this doesn't know, basically companies come out with their earnings every 3 months. I'll probably listen to 40 to 50 earnings calls.
How long does that take?
So nowadays you've got 2x speed. Okay. So basically most earnings calls are 1 hour. 2x speed is 30 minutes.
30 minutes.
So
per company.
And you
Correct. Have 40, you said?
Yeah, I'll usually listen to 40, 50 earnings calls. I don't own that many stocks, but sometimes I'll listen to other companies to get insight on the economy or what's going on in other industries, competitors of my companies, things like that. So that's why I'll listen to way more than actually what I own.
As you're talking about research, you mentioned when you were at Quick Trip, you were working as a manager at this gas station. You ended up building up this portfolio. It was nearly $200,000 by the age of 25. Then at age 28, 29, you became a millionaire, which is an amazing accomplishment at that time. That. And I'm curious, how did your view on risk change? Because at that time, you were investing so much. Was there a certain point where you had accumulated and built up this portfolio where your risk allocation and how you decided to, let's say, have cash versus investments, did that change over time as your portfolio grew?
Yes. And so the stock market's interesting. The financial markets in general, they have a way of bringing you back, I feel like. And because as you have more and more success, you almost start to want to take more and more risk, at least for me personally. I can't speak for everybody. So 2018 was actually a year where I got checked, because I started getting into margin. I started getting into doing earnings trades, which essentially I would kind of understand like what a company's going to report for numbers and then make a bet on that stock, which was going against everything that made me successful, which was long-term investing.
Can you kind of give an LE5 version of what margin is for people?
Yeah, margin's basically investing money you don't have. So basically you take $1 of your own and then you invest another $1 on debt. And it's super risky because you can get margin calls and things like that.
Which is when a stock drops below a certain price threshold,
yes,
and then the brokerage or the company calls for their money back.
Yes, exactly. So that would happen to me in 2015. And that brought me back in terms of like, dude, you got to get back focused on long-term investing and quit all this earnings trades and all that stuff and all this margin stuff. So that brought me back to reality, definitely. And I feel like actually this past year definitely, took me to that place as well, because obviously 2021 and 2020 were such years of taking risk. I feel like this year is one of those years that kind of focuses you back on make sure you're really researching these companies. Don't touch anything that you are not 100% in the belief that this is going to where you think it's going. If there's any question, even if you think the risk is there, you got to watch that. So it's interesting. That's the way the financial markets are. They check you every once in a while, so your head doesn't get too big, and so you don't think you can do everything, I guess you can say.
Is you reached millionaire status by the age of 30, which kind of segues into the question of how were you able to do that? So you quit your job, and when did you decide that YouTube was the thing you wanted to pursue full time?
Yeah, so go back, basically at the end of 2015, at the beginning of 2016, it was like, I had a kid, I had a wife, I'm like, I need to do something for work, and I had my batteries recharged by that time, like I'm ready to make money again, do stuff. So I started my real estate marketing company. Now, that was really slow. Like if anybody that's ever started a business, it's usually not popping right off the bat. Usually it's a slow build, and you kind of build up over time, right? So I would have this downtime, I'd send out all these emails and stuff, and had lack of jobs. So then I was like, I'll just record a YouTube video. And I started with like these 1-minute videos, which was probably a good strategy. That ended up becoming TikTok and all those things, right? And I'm like, in 1 minute, I'm gonna explain to everybody what a savings account is, what a checking account is.
What is a Roth IRA?
Yeah. What is a CD account? In 1 minute, I'm gonna do it. And
this was before anyone was really doing this.
Yeah. And so I started doing that. Then I think I started getting a little busier on the real estate marketing company, kind of left YouTube for a little bit, then came back. Then real estate marketing company got even busier, kind of left to YouTube again because I wasn't really making any money. It was just kind of like a side thing. And then my real estate marketing company had more and more success. And at the same time, I was like, you know what? I'm just going to keep going after this YouTube because I would see I'd grow like 3 subscribers, 5 subscribers, 10 subscribers. And the first video that started getting a little push for me was a video called How to Negotiate a Car Deal.
Okay.
And I think I might have came out with that either in the summer of 2016 or maybe fall of 2016. And then in around, I think it was September of 2016, I did my first 3 stocks I'm buying series. And that got like 5,000 views, which was crazy at that time. And that's when I was like, okay, I need to go hard on this and hard on the real estate marketing company simultaneously.
But were you already making money from YouTube at that point when you made that video?
My first entire year, 2016, I think I made less than $2,000.
Wow. And after how much time did you put into it?
Oh, so much time. I still did like 100-something videos that year.
Oh my God.
Yeah. So
the curve was exponential, right?
Yes.
Because the following year, did you make...
Okay, hold on. So first year, less than $2,000.
Yep. And a ridiculous amount of time. Second year, oh gosh, I can't remember what I made my second year. It was 2017.
I can tell you.
Can you?
Jen can tell you.
Okay, how much is that? I actually can't remember.
So I read an article on Business Insider that said second year you made about $50,000.
That sounds about right.
Revenue.
And then in YouTube AdSense, I believe, from YouTube.
Yeah.
And then the third year about $250,000.
Yeah, that sounds about right. Yeah. So
and we're just talking about ad revenue though. Yeah. We're not even talking about some of the other stuff you were doing, which we'll get into in a bit. But $250,000 on year 3.
Yeah. And what I noticed is people wanted me to talk about stock market. Like that's really what my calling was. And, that's what I'm most passionate about. So before that, I was kind of doing all things finance. I was almost kind of approaching things a little bit like you and Graham back in the day.
Yep.
And I would do these videos on like passive income and things like that, which were awesome. But what I really felt is I felt super passionate about the stock market. People really want to hear my opinion on the stock market. And so I think it was around 2018 I started transition to just being stock market, and I'm like, all the other finance subjects I can be that, but I'm going to focus on my thing, which is stock market.
Yeah.
So.
And you became the biggest stock market YouTube channel at that time.
Yes.
Which I think you still might be.
Yeah, I mean, it depends on what you view it on. Is it subscribers? Is it views? Is it relevancy? All those sorts of things. But I mean, yeah, and obviously, I mean, for a while, I was the biggest kind of finance YouTuber in general, and then that torch got obviously passed to Graham.
Sure.
And he just carried on with kind of personal finance in general, and I just went kind of the stock market route. The interesting thing about me, I never really had a year where it's like, oh, this is Jeremy's year. I feel like you've definitely had that. I feel like Graham definitely had that. I feel like I never had that. I was just kind of a slow, gradual build, and it got bigger and bigger over time.
Two questions. If I'm somebody watching and I'm considering doing YouTube, but I'm obviously considering investing as well, what's the most useful advice you can give to somebody who is trying to learn investing, whatever it is, whether it's your most important advice, whatever it might be, or to invest or to do YouTube? What would one of your two pieces of advice for both of those people?
I mean, I think, when it comes to YouTube, you got to make sure you're passionate about it. You got to make sure you're going to stick with it. I think consistency is very key. And
would you say that's the most defining trait?
I think it's certainly one of them. I don't know if it's the most defining, but it's certainly up there. I've been doing this since 2016. I've seen a lot of people come, a lot of people go. A lot of people do way better than I even thought they were going to do, and some people do far worse. And I can tell you every time somebody does far worse, it's because they weren't consistent.
Right.
And they kind of, even though they had this huge opportunity in front of themselves, they kind of let it fall to the wayside. And so, I mean, you can manage all these things simultaneously with investing and things like that. But, obviously the finance niche is a certain kind of niche that can be certainly very toxic, especially if you're in the stock market space. So I would just caution people, even if you're whatever you're talking about, you could tell people, hey, go buy an index fund, and there's going to be people obviously saying, that's dumb and that's stupid, and it's a very toxic space. So just do understand if you're going on social media.
Which is the craziest concept to me, because before I started YouTube, when I thought about investing, I was like, that's the least controversial space you could be in. I didn't think anything of it. I just said, oh, of course, people invest. How could it be controversial? But you're right. The longer I've done this, the more I've realized how subjective investing actually is, and how everyone has their favorite method of investing. And if somebody doesn't agree with them, they must be a scammer or something's wrong. And it's an interesting industry for sure.
What it is, I think people get very, how do you say it?
Passionate,
about their reasoning.
Right.
And so if you're telling the people to go buy stocks or index funds or whatever it is, right? And there's somebody that's like, no, we're going down a ton more. They're going to be like, what are you telling people? Like, that's an idiotic move. If you're on the other side, they're like, no, look at the last 100 years and how the market. So no matter what, you're going to have a segment that's definitely going to not agree with you. And I mean, I was talking to a gentleman, I think it was at Dylan's birthday party, and he was saying how he's a house flipper, and he's made a killing obviously the last few years. But now he's talking about, oh man, I'm kind of pooping my pants here, man. I don't know what's going on with the market. He's kind of scared. He's maybe a little over leveraged, he was saying, and things like that. And it's like, well, he did really good for a while there, but then all of a sudden you're going to have a year or two that could, be obviously really down. It doesn't mean your strategy's bad or you're bad at doing that thing. It's just, it's the market.
Sure. Or it's your age too, because if you were a bond investor for the last 10 years, people would have looked at you like you were crazy.
Yes.
Why would you ever want to invest in the bond market? It's been negative when compared to inflation, right? But if you're older and you have wealth to protect, it makes sense to be in bonds.
Yep.
So it's such a subjective world, but it confuses me when people get so passionate about being factually objective about everything.
Yeah.
Are you comfortable now talking with us about your net worth at this point? We know that you had made 6
Jen,
years.
where did that come from?
Well, we're at the spicy level.
Yeah. So. No, I leave that. That's one of the things I never touch, the net worth. I like that.
Net worth.
Yeah, I let that be that. No one knows my net worth. Not even my own wife knows my net worth. So
why is that a secret?
It's just fun. That's what I find. It's more fun because so many, obviously a lot of people disclose it, and then I just kind of keep it a secret. I just think it's fun, and then people are like, I love to hear people's guesses. Like, I think it's just much. Like, Graham loves to guess. He's the guess master.
I love guessing too.
Yeah, Jack does too. Like all those guys. Like, I think it's this number.
I feel like it'd be really fun because you could be like 10 million one day, and then be like negative 500,000 today.
Exactly. Yeah.
Jeremy, I had an investing question for you.
Yes.
So you know how EV stocks kind of went through this phase of like everyone was buying these EV stocks. It was like the craziest hype phase. Woo. There was also the fintech phase where everyone's all about fintechs. In the next 10 years, what do you foresee as kind of like the next up and coming sort of technology? What's like a thesis you have that you're like, this is the thing that's coming? I know Dylan has a lot of opinions about it. So Dylan, who by the way helps produce this podcast, he can answer that question. I know his answer would be AI.
Yeah.
Dylan loves AI.
Yeah.
What's that next big thing? It's hard to say because what you kind of need is you need a bunch of stocks in the market to become available.
Right.
And people to get hyped on it, and it's kind of hard to predict that. And I've watched it play out in a lot of stocks. 3D printing stocks. I remember that was a whole cycle around it was either 2013 or 2014, and 3D printing stocks went insane, and it was like, it's the future. And then they all crashed like 80, 90%.
Yes.
Then it was...
the fitness stuff, too. What was the...
There was Peloton that was more recent.
Yeah.
There was a Jack Jackson plays around 2017 or 2018? The Jack Jackson plays were the thing. Then I remember crypto mining related companies became a thing for a while. And then it was obviously EV companies. And those obviously went through a whole cycle where everybody was like, and then almost all those stocks other than Tesla are down at least 50%, but most of them was like 70, 80%.
I also don't want to misspeak, but I remember there was also the phase, it didn't quite have its own phase, but I remember people like Kevin O'Leary talk about the psychedelic stocks or the psychedelic stuff. I remember that was kind of coming up. Yep. Yeah. It didn't quite have its time, but I remember people talking about it. Is there anything you feel like it could be, perhaps AI or something? Could it be crypto again? Yeah,
I think cryptos will have another one of those cycles. It's just the question is it like a year from now, 2 years from now, 3 years from now? Like, when is that? So, there's many various factors at play, but I think, the market sentiment changes quick. And as you've seen, so in a year or 2 years' time, things change quick.
Yeah.
And all of a sudden, a year could be back risk on and, it's flying high again. It's funny how fast things can really switch.
I actually just recently spoke to a friend of ours. He's a hedge fund manager who manages, I think, a little over $100 million, which I probably not a huge amount of capital in that space, but still pretty significant. And according to him, he says he feels like one of the things that where the markets really hit a bottom is when you feel like there's capitulation in the market, which to him anyway, he says is when they start selling their favorite stocks, which is like the Apple, the Tesla. Once people start selling that's really when you've truly hit kind of rock bottom, is that capitulation phase. Would you kind of agree with that?
Yeah, there's a few ways to measure it. There's something called the VIX, which is a volatility index, which basically measures how crazy the market is at a given moment. And usually when that spikes above 30, you're in a pretty, rough time usually in the market. If you ever go over 40, that's an incredible moment.
Well, what's interesting to me, I remember looking at Robinhood stock. And Robinhood, by the way, tells you whenever you buy a stock, other stocks have been bought based on this one stock. So if I remember when we were talking about, say, Tattooed Chef, the Robinhood app would actually say people also buy, people who buy Tattooed Chef also buy, and it had a list of the stocks you actually invest in, which, is crazy because you have such a massive influence to where I feel like you definitely have a niche and a pocket of people that can, in some cases, move markets.
Yeah.
Where it's like there is a certain similarity. It's pretty interesting.
I know it's certainly something. I am aware of it, definitely. And there's definitely a lot of money that follows me.
With great power comes great responsibility.
Yeah, exactly. I mean, there's and I've publicly stated this before. I mean, just in the private stock group alone, we've got 100 plus people that have joined over time that have a minimum of $1 million just in stocks.
Right. And here's the thing where the big difference is that I think is why I trust your integrity is because you're not a trader. You're not a day trader. If you are somebody who shorted stocks or sold positions really quickly, I would say that's potentially not necessarily crossing the line, but that's when you get into the gray area.
Yeah.
Whereas I feel like because you're a long-term investor, and as long as I've known, you're the kind of guy that has a thesis about something and you just stick with it.
Yeah.
Even when it sometimes
looks bleak.
Yeah, exactly. Even when it seems like you're falling off a cliff, you believe it and you go with it.
That's a good way of putting it, falling off a cliff. Thanks, Audra.
Well, I'm just saying when it looks like a long shot and the market doesn't, have your same conviction, you've stuck with it. Yeah. And I feel like that's what makes the difference of why I trust your integrity, because you're not somebody who says, hey guys, I bought this stock, and then 5 minutes later you sell it.
Yeah.
That's when I would say you get into the questionable territory.
Oh, 100%. Yeah, and that's when you get into legal problems as well. There's a whole host of problems that emerge there. I mean, the way I kind of look at it, right, is if a stock, I'm always, let's say my portfolio is 15, 20 stocks. If those stocks are falling, I'm going to add more ownership. And it goes back to what we spoke about earlier, right? So that's why I don't get too caught up in this whole it's going down or things look bleak. I'm kind of like, where do I see this business going over the coming years? it's 50% cheaper than what I used to pay for it. I like it,
right?
You know, and I'm going to add more ownership of it. And now I get to add 2 shares for every 1 share I used to get to buy.
Right.
Do you keep a good amount of cash on hand so that you're able to do that?
Yeah, generally speaking, 10 to 30% cash. Okay. And what I'll do sometimes is if the market is in a stage where it's riding high, I'll cash up more. And if we're in a time period where obviously the market's crashing, like pretty much all of 22, I'll be deploying cash very heavily. So let's say hypothetically, I'll give you an example. Let's say the market goes risk on, meaning, you know, stocks are flying high over the next 2 or 3 months, which is certainly a possibility. Then that's going to be a time period where I cash up. And not where I necessarily sell stocks, but where I'll just, instead of putting income out there in the market, I'll just put it in savings and just hold it there for a bit and then kind of reassess things kind of down the road.
Mm-hmm. Now, Jeremy, where do you cross the line into getting into like the trading category or swing trading, where it's like sometimes you do have to sell if you're overweighted in one stock, but when does it become like trying to time the market?
Yeah, I mean, when it comes to selling, I think a lot of times what it comes back to, do you still believe in the company? Is the company way overvalued?
Okay.
On where you think it's going over the next 3 to 5 years? And that gets in a whole other super deep subject that we could talk about for 6 hours. But that's the way I personally view it. And if I feel like an asset's overvalued and I have a much better place to put the money, that's when I'll usually go ahead and sell out. I usually don't sell a stock to go cash. That's usually not an idea for me. It's not like I'm like, oh, I'm going to sell the stock and now I'm just going to put the money in cash.
Right.
So, and usually if the market's also flying high, what I'll do sometimes is I'll start actually looking more at dividend stocks.
Yes.
A good example of this is in when was this? This was
2020, actually, when everybody was talking about Tesla and nobody wanted to buy oil stocks. I was buying heavy. Yeah.
I love that. And, you know, for me personally, at the end of 2020 going into 2021, which was a high flying market, I put $1 million in Walgreens stock, which is a super boring stock, obviously. But I just looked at it and I'm like, I'll collect the dividend money. The market's flying high. You know, a lot of these stocks are obviously way overvalued, and that's where I deployed capital. So I also look at it from kind of that standpoint. But yeah, and I try to run the money the most professional way as possible. As possible, you know, 5-10 years from now, I, you know, do something with a hedge fund or something like that. And so I kind of think about like, you know, I don't want to say it's timing the market, but you got to figure out those moments where it's like, okay, now I need to cash up a little bit. Now I need to deploy a little heavier in these dividend stocks over here, because obviously, you know, let's say let's say I put all my money at the end of 2020, at the beginning of 2021 in Shopify. I lost 80% of my capital.
Right.
You know, stock's down 80+% since then. And even though Shopify might climb back to that 5 years from now, it's like, it's not fun to be in that sort of situation.
Do you think that Tesla will still be a $5,000 stock in a couple years? Because I remember talking about this in 2020 with people, and everybody was convinced that it's going to be a $3,000 to $5,000 stock, and they had all these ideas of how it would happen. So I'm curious, do you still feel the same way?
Yeah, I mean, well, one Tesla stock split since then, so I think Tesla's real share price right now would be like maybe $900 or something like that. So just so people that are watching this are looking at it and like, wait, this Tesla stock's like $300. How's it going to get there?
Right.
I mean, it's certainly a possibility. They're just going to have to keep putting up growth, big growth too, in terms of, you know, amount of cars sold. So I wouldn't say it's out of the realm of possibility. I would call it a challenge.
Okay, a challenge.
Yeah. A real challenge. Not going to be easy to get to that place.
Do you think they're still overvalued, or do you think they're fairly valued right now?
See, that gets into short term versus long term. Short term, every metric on Tesla screams
overvalued. Okay.
Yeah, short term. Long term, when you start running the numbers on, well, I think they're going to sell 5 million cars and then 10 million cars, and they're going to make this much profit per car, and they got this business line. Then you start running the numbers, and you're like, oh, Tesla's actually undervalued right now. So it depends on what your outlook is. If it's 5 years, Tesla could actually be undervalued. If it's 5 months, it's actually way overvalued.
Interesting. Okay, so I guess there's how do you balance between current valuation and long-term valuation? Because long-term valuation, there has to be some level of faith. You have to believe in something, even though there may not necessarily be evidence of that thing. And then that's I feel like that as somebody who, you know, is passionate about Bitcoin, who maybe understands the monetary system and kind of understands its significance. There is still a level of faith that I think some people just don't see. And so how do you balance the difference between current and sort of future valuation?
Yeah, so I mean, my kind of outlook on that is you got to try to say how much of this is faith and how much is this going to be potential reality. And no matter what, you still have to use your imagination. And that's why actually the most underrated thing in stock market investing is probably imagination. Because no matter what, when you're trying to predict the future and what's going to happen in the future, you're going to have to use your imagination to get to this place of like seeing something that's not there become a reality, right? And so for me, it goes back to kind of the risk reward. Like, and I go back to net income. Like, what do I think a company's bottom line net income is going to over the next 3 years, 5 years versus what their market cap is now versus what I think their PE ratio is going to justify 3 years out, 5 years out. So, I mean, it gets a little complicated in there, right? But that's my personal view on that. And then I say, how realistic is this happening? Because like, let's say for instance, Tesla. I could have an opinion that Tesla's going to sell 15 million cars a year in 3 years. How realistic is that? I'd call it less than a 1% probability. That's extremely unrealistic in my opinion. Now, if I say 15 million cars in 15 years, I think that's a possibility, right? So I think that's where you kind of got to draw that line of like, what's realistic here in what could actually play out. And
it seems more of like an art than a science.
It is. It's a little bit of both, to be honest. You've got to kind of be able to see around the corner a little bit, and at the same time be able to understand income statements, balance sheets, cash flows, and those sorts of things, and understand why if it's a consumer company, why is a consumer going to want this product or service over the coming years? If it's a B2B company, meaning a business selling a business, why does this business have to sign up for this or want to sign up for this? And then when you kind of understand that a little better, then you can kind of go to the financials and all those things. And Buffett, I learned this from Buffett a long time ago. He always says start with the business first and then go to the financials and things like that. Because if you look at just the financials, you can be influenced because you're like, oh, the income statement's so good. But if you aren't thinking about the business and where the business is going, you could obviously be in a bad position.
So in the industry, that's called look at qualitative rather than quantitative analysis. Yeah.
Yeah.
Well, thank you so much, Jeremy.
Yes,
you're
thank you
amazing.